everyone, and welcome back to another episode of Let's Talk Creole. I'm your host, Ysmaine, and here with me is my amazing partner, lender, Kelly. How are you doing?
Great. How are you?
Good, good. So excited to be back because we took a little bit of a break. This was a long time coming, it feels. So we're excited too because we have some good content for you guys today. And as usual, to get started, we're going to start with the myth of the day. And Kelly, you probably can get us started on this one.
Yes. So what better to talk about than getting a loan approval?
Mm-hmm.
So anyway, our myth is I can use additional loan approval amount to cover your closing costs or to put towards renovations to a new home when you're purchasing a home.
Yeah.
And the answer to that is no, unless you're doing like a 203K loan. So
Which is designed for renovations in particular. Yeah.
Correct.
Yeah.
So we don't offer that here at Sierra. There are some lenders that do offer the 203Ks. But the myth when purchasing a house, normally any additional loan, like the loan that you're approved for,
Yeah.
is the loan that you're paying to buy the house. You can't use any of the rest of the money from the pre-approval to go
towards the house. Yeah, I get that so often. I feel like this is one of the most common misconceptions that I get from buyers coming in brand new, like never bought a home. And it's an easy mistake to do, I guess. They get an approval for $300,000, they find a home for $250,000. Can I use the additional $50,000 the bank was telling me that I approved for to put it towards closing costs or to put it towards renovations? And no, you can't. That's just the max amount the bank is willing to give you towards the house, but they are only going to lend you what the house appraises at.
Right.
So the approval amount is really just to give you a search criteria.
Yes.
To go by, but not necessarily the actual money the bank's giving you so you can use it however you want. That's not how it works.
Correct.
Yeah, that's a big one. It's funny how this one actually happens a lot.
Well, the only reason I bring up the 203K is because it is a thing, but there is a lot of criteria that goes into you can't just get a pre-approval for a 203K and that extra to whatever you want to do. Like there's way more.
It's a different process, it's a different type of loan altogether. There's a different requirements. You really expected to put a different size of down payment in comparison to a primary residence. And they also have to approve based on the property itself that you're planning on purchasing, because every property is going to have a different loan amount for the 203K in particular. Because if a house is approved, let's say they determine the value for that property is after renovations is $250,000, they might give you $200,000 for the purchase and $50,000 for the renovations.
Correct.
And that's for that particular property. So very unique type of loan. We can maybe do an episode about it, do some more research and bring that up as an episode option. But it's not the same as like, hey, I'm buying a house for myself. I'm not planning on doing renovations, just buying a house. No, you cannot use approval excess amount towards the closing costs of renovations.
Which we're going to get into the details of that.
Yeah, exactly. So today's episode is all about pre-approvals. So you guys are going to understand, and Kelly's going to give us a real good insight on what is a pre-approval, why is it important, everything you need to know to be better prepared or, get started with your home buying process. So let's get to it. So what is a pre-approval, Kelly, and why is this so important?
Pre-approval is an amount that you are approved for to purchase a home. And the pre-approval involves a lot of different things, which we're going to get into that. So this would be, the pre-approval includes a purchase price along with your loan amount, which your loan amount and your purchase price, there's always a down payment involved with that. It depends on, how much money you're looking to put down. And those are a lot of different questions that we'll ask. But your pre-approval amount is basically the loan amount, the mortgage amount that you're approved to pay on once you purchase a house, whether it's 30 years, 20 years, 15, I think we go as low as 10. So it's that purchase price with the loan amount that you're approved for to purchase a home.
And it's also going to let them know what type of financing they're getting. So what kind of loan amount would be an FHA loan, a USDA loan, VA loan, conventional.
And that's where the different down payments come into play. So real quick, I want to say there's a difference between an official pre-approval and a pre-qualification.
Yeah, big time.
So pre-approval, you, like, as me as a lender, I give out pre-approvals because I collect the documents to show what money you're making, how much money you have in the bank. Now our systems are kind of like on steroids, and we can do a verification of employment for many employers right in our loan system. I can also do a verification of assets. So I just click a button and the borrower gets an email, they follow a couple steps, and their account gets loaded right into our system. Now, not the whole statement, so it gives us what we need to see: the balance, the last 4 digits of the account number, the name of the customer, and the name of the creditor that holds the account. So we pull credit, we look at the debt versus the income, we do the whole 9 yards. So that's why when we give out an official pre-approval, it's an official pre-approval. Whereas,
and I can even chime in that too. Why is it important? Well, I tell you why. Other than understanding exactly how much you qualify for, what's your loan amount, what kind of financing you're having, maybe even understand what kind of interest rates you could potentially get, all that stuff. You also need a pre-approval if you want to put an offer on a house. You cannot do an offer on a property without having an actual pre-approval, not a pre-qualification. So if you're going online and just putting in, typing in information, and you get like those online pre-qualification letters, and they may even write pre-approval letters in it, but that doesn't mean it is. Those are not valid for writing an offer on a property. So that's why it's so important being very prepared, especially in this market where properties are flying off the market, flying off the shelves in 3 days. So,
and your sellers, they want a pre-approval.
Yes.
Like, a pre-qual, like you can get a pre-qualification, and even some lenders only give out pre-qualifications. I don't know who they are, but I know I've come across people who have only gotten pre-qualifications, not that it doesn't have a cost estimate. You always want to get a cost estimate. Yeah. There's a big difference between a pre-qual and a pre-approval. And pre-approval is what you need to have in hand. That is why it is so important, especially if you want that house.
Yeah. So let's get more in depth then. So what's the pre-approval process exactly?
So basically, obviously the pre-approval process starts with trying to figure out how much you can afford. And, with the pre-approval process, it's, you want to sit down, you want to do your own budget. You want to contact a lender like me. There are 3 things that will happen. First off, we'll collect your information. I'll get I hate to say application information. I usually like to say pre-approval information. People get scared when they hear the word application.
Application, yeah. So am I committed to something? What is this? So signing up for college?
But basically that's what it is. It's your personal information. We need to see a 2-year history of work and where you've lived. 2 years is the main thing that we like to look for, and we pull your credit, we look at your debt versus your income. So obviously we're going to get your employment for the last 2 years. We're going to base your pre-approval off of what you're currently making right now. Now, like I said earlier, talking about the pre-approval, our loan system can pull a verification of employment on your employers. If it does not, I'll know right away. So if it does not, I will collect. This stuff has to be collected anyway, but I will collect W-2s and your pay stubs for the last 30 days, just so I can verify that your income is what you tell me it is. But if my system pulls it, then I don't need to collect it to give you the pre-approval. But if it doesn't pull it, then I will collect those documents from you along with your bank statements. So pretty much we get all your information. We have to verify.
Tax returns, so important, right?
What's that?
Tax returns.
Tax returns. So if you're self-employed, we do need 2 years. Now I'm not an accountant. And some products we only need 1 year. So it all depends on which product you fit into. but for the most part, it's a 2-year tax returns for self-employed or 1099. And we plug that information into our Loan Beam system, and it tells us what your income is. So that's how, if you're self-employed, that's how I'm able to, and it does work on weekends too, so I can do pre-approvals on the weekend. And so that's how, so we need to figure out what your income is and what your debt is to determine what that loan amount is that you would be a pre-approved for to go look for a property. So once I do that, I issue a cost estimate so you can see what the cost is to purchase the house, as well as the pre-approval letter that shows what your purchase price is, your loan amount, and what your interest rate it will be. And we'll also have an APR. APR is what you pay over the life of the loan, including all the fees involved. Yeah. APR is always a little bit higher than what your actual interest rate is. So that's pretty much the process in a nutshell.
Yeah, good. So part of that process is what we're going to talk next, is looking into your credit score. Yep. And Kat is going to give us a little bit of a summary of what is the credit score and why it's important and how that impacts your ability to pre-approve.
Yep. So with Sierra, our lowest credit scores that we accept, we pull from all three, Experian, Equifax, and TransUnion. And we take the mid score, and that mid score through Sierra has to be 620 or above. If you're looking to get certain grant programs, it would have to be 640 or above. But all of our products, including USDA and VA, is 620 now. If your mid credit score is below the 620, we do have some brokers that we can broker it out to. We can go as low as 680. But if you're not willing to go through the brokerage and you would like,
580, right? You meant, yeah.
Oh, did I say? Oh, yeah, 580. I'm sorry. I apologize. Did I say 680?
Yeah.
Like, damn. Go as low as 580. And we've done that. I do that all the time, and sometimes the pricing is a little better too through the brokerage, but yeah, so that's what the minimum credit is. But credit is super important. We review the credit. We see what's on there. If there's any delinquent files, any delinquent accounts, we like to see consistency of you're paying your bills on time. And, if you are, then most likely you're going to have a good credit score. But if you're not, we do have a system that I can work with you on it to help bring your credit up. I plug some numbers in just to see where you can, if you need to pay something down or pay something off.
And guys, this is free, by the way.
Yes.
So please, if you need to work on your credit score, before you end up falling into one of those traps of online services to help with credit score, reach out to Kelly first, because she can give you really good pointers. Her system really kind of guides her on showing her what you need to do so you can take the right steps yourself without paying anybody for it. So do talk to her first.
Yep, because I can just plug some numbers in. A lot of times it's just paying things down to 30% of the balance. Sometimes if it's a collection, sometimes it's paying it off and getting it closed out. We do need documentation on that. So whenever I work with anybody, or whether you're working with me or somebody else, if you do pay things off or down, keep all the paperwork on it. That is super.
It's so much simpler.
Because we'll need that, because I would need that for them to send to me. It needs to have 4 things: their name, the creditor's name, the last 4 digits of the account number, and what the new balance is, whether it's the 0 balance or just down to the 30%. Yeah. But that's the biggest thing with credit is if you have to work on your credit, you need to make sure you keep all the documentation, because then I can use that documentation to help bring the credit score up.
Very important.
Do you have any questions on that?
No, I think that's very well explained. Yeah, just basically if you're in doubt, call Kelly to help you with your credit scores.
Yes, absolutely. It does require me to pull your credit, but if you feel like you're a little bit below where you need to, we can certainly look at it and work on it.
Exactly. Yeah. Or even if you just want pointers and guiders, like, hey, I know that I'm more or less on this from this free websites, Kelly can still like say, look, if you do this and this and this is like commonly something
There, you can pull your credit report for free on a lot of different credit. If you have credit cards, there are a lot of credit cards that allow you to pull it for free.
Yeah.
So that's what I recommend to a lot of people.
Yeah. So getting into our next topic, which is part of the approval process as well, is the debt to income ratio. We hear that a lot throughout, the pre-approval processes, even afterwards as well, when we're looking for homes. So explain to us a little bit more about what that means and how that impacts ability to purchase a home.
Yep. So your debt to income ratio basically is all your debt versus your income. Simple as that. So, but there are two numbers that we like to see, and they are 28 and 32. Do we see them? Not very often.
Now with today's consumerism.
28 is what the new mortgage amount will be versus your income. And then the 32, which is what we call so the 28 is the front end ratio. And the back end ratio is the 32, which is all your other debt that you have, whether it's a car, credit cards, anything, and the new mortgage. So we have that little bit of percentile in there. That number can go up to 55% on the back end for FHA.
Yeah.
So for conventional, I don't like to go above 40. You can sometimes, if the credit's really good, you can sometimes go a little bit higher, but I try to keep it for conventional at 40. FHA, like I said, you can go as high as 55. Yeah. VA and USDA, they are like hard stops at VA, I think is 41 or 2, and USDA, I think, is around the same. And they're like, when I say it's a hard stop, you can go a little bit higher, but then it's a oh my gosh, what's the word? A manual underwrite.
Oh, gotcha. Yeah.
Sorry.
It goes to a final review before it can be approved.
Yeah. So if you go higher than their hard stops on their approvals, we can do a manual underwrite, which I've done them too. They're not impossible to do if, sometimes there's a little bit more in the credit than they thought. We can look at with manual underwrites, but manual underwrites require a lot more documentation. So as a lender, we need to look at your debt versus your income to make sure that you're approved for the loan amount and purchase price that you're looking to purchase. So that's all part of the pre-approval.
Yeah.
So do you have any questions on that?
No. So that's pretty self-explanatory there. Yeah. So the next topic is the difference between your pre-approval amount and your budget. And I think that's a very interesting one to even consider before you even get approved, right? We mentioned in the beginning of our podcast about budget and understanding your numbers. A lot of people may come to me sometimes before they even go to you, and they tell me, I'm okay paying up to, I don't know, $1,500 mortgage, because they ran the numbers, they understand their budgets, and they think that that's what fits. But they might end up approving for, I don't know, a $400,000 home, which, as we know, as of today, you're paying way more than $1,500. So they don't have to buy a house based on what the appraisal amount, approval amount is. They have to stick to their budget, and understanding your budget is so important during this process of procuring a new home. So if you want to give more insight on that as well, and your perspective on that.
And this is a big part of the process, is coming up with a budget.
Mm-hmm.
We still, Chad, my husband, still hand writes everything. It's a good idea to keep track of all your bills right now, not just your debts, but like your cable,
ongoing payments.
Some people love to watch TV and have big cable bills. Some people like to buy cars. Some people, everybody has a different story.
Yeah.
But it's very good to write down, whether you do it in the computer or whatever, write down what your monthly debts are right now. But to include in that, also write down, well, how much food do you buy?
Yeah.
Every week, or just your Dunkin' coffee that you buy. Those are that's called budgeting. You need to see what you're buying, and if you know what you feel you can afford for a payment, and maybe your budget when you go to get pre-approved isn't as high as you thought it was going to be. Well, then maybe it's time to start buying those Dunkin' Donuts or Starbucks, every day, because budgeting is making sure you have that money to pay for your mortgage.
Yeah.
And it's key. It's just knowing how much you can afford with the other things that you like to buy.
Yeah.
Knowing what those payments are, because like you said, a $1,500 a month payment might be for $150,000 loan amount, give or take.
Yeah.
Could be more, could be less, but there are things to take into consideration when you purchase a home. You have your principal and interest that you're paying, but you're also paying taxes and homeowners insurance.
Or even HOA if it's in a community.
Correct. Some of those things you don't necessarily have to pay in your mortgage. Most people do escrow for that and have it included. But even if you don't, you still have to be approved for those amounts.
Yeah.
As a lender, we have to still include them in your debts, even if you're not going to escrow and, pay them monthly. It's still a debt. So
it's still part of the property, owning a home. So you have to.
It's not a debt. I said that wrong.
Yeah.
It's still part of your payments.
Yeah.
So, when you're budgeting, it's looking at all the numbers and what you feel comfortable affording. And, some people, I can pre-approve them up to a $400,000 loan, but hold up, that's not what my budget tells me that I can afford. So everybody's different. Some people think their budget is $400,000, but it's really not. So, but there is a lot. It's all about knowing what you're comfortable with and figuring out your budget before you pick up the phone and call a lender.
Very true. Very true. This is a very common question too. How long does a pre-approval last? And I know even when they ask lenders, some lenders may have different responses, but we all know you can explain exactly why and how long.
So pre-approvals usually, I say usually because every lender is different, last for 120 days. So it's when we pull credit, that's like the start day of, because the credit only lasts for so long.
Yeah.
So, and the credit is usually good for 120 days. When I do a pre-approval and I send it out to my borrowers, I always say, this is the date that your pre-approval is good for. If they don't find a house within that 3 to 4 month time frame, then we'll have to do a re-pull on credit.
Yeah.
Does it affect your credit if we keep doing that? It does, but not by a lot.
Not if you're doing only once every 4 months for the same purpose.
Correct. If you're always making your payments on your other debts on time, your credit score could go up.
Yeah.
Creditors like to see you using your credit and paying it on time. If you continually do that, your credit score will only get better.
Yeah.
But so pre-approvals, some lenders say 90 days just to be safe. So if you say 90 days, you may still have some time
to extend it
under contract, and it still might be good. Like the credit report still might be good enough to get closed. So if you get under contract and you're close to that 120 days, we will have to re-pull your credit prior to closing because of it only being good for 120 days.
Yeah. And you usually have to re-pull anyway, right? Before, don't you have to re-pull? No? Only if it's past that 120 days.
Only if it's passed.
Gotcha.
So if you open up new debt, we'll know. Like we're notified if new debt is opened up because our underwriters are magical and they know. I don't know how they know, but they know.
They know. Oh, so let's get into that then. The do's and don'ts after you get your pre-approval. And right there, you just said the biggest don't.
The biggest don't is no big purchases.
Yeah.
So that And what I mean by that is if you're looking to purchase a house, don't go buy a car.
Yeah. Uh-uh.
Don't buy furniture.
Don't get a loan of any
If
kind.
you're going to get married, buy the ring for men, or women, men or women, doesn't matter.
Yeah.
You know, your engagement rings, they can cost money.
Yeah.
So no big purchases.
Yeah.
Like if you're pre-approved and you're ready to go start looking at homes,
That's
don't
all
go-
you're doing.
that's all you're doing. So you can't use loans to go towards down payment and closing costs.
Yes. Yeah.
So the only loans you can use to purchase a house is a home equity line of credit. If you're currently living in a house and you're buying a new house, you can use a home equity to purchase the new house.
Yeah.
You can actually open up the home equity, not even touch it, and use that as down payment.
Yes.
Or you can take a loan out on your 401k. Those are the only two that you can use to purchase a house.
And you shouldn't be fined or have any fee or penalty if you're using your 401k towards buying a house. Because a lot of people always is scared of that. But if you're using towards purchasing, like that, buying a house, paying closing costs, that if there is a fee, should be waived. There will be a fee if you're borrowing for any other purpose. But if you're using towards a house payment or a house down costs, whatever, closing costs, you should not have a fee there. You can get a waiver if your bank insists on charging you. That should not be there. But yeah, so those are the only two. Home equity loan if you own a home already, or your 401k if you don't. And that's the only two kinds.
And the thing to do, I would say the number one thing to do is just save.
Yeah.
So
Continue saving.
when you figure out your budget and see what you need to do with your budget, stop buying your Starbucks or your Dunkin' or whatever it may be.
Yeah.
Just start saving money if you don't have enough. But those are the things that once you're ready to buy a house, it's time to stop purchasing, making big purchases, and start saving your money and just keeping the money aside. Each paycheck or however it is that you save. But those are the two biggest things. Don't buy big things and do save
money. Yeah. And don't be paying off too much, all entire debts as well. Correct. Because that can talk to your lender first, because that can actually stop you from actually qualifying. So don't think like, I'm just going to pay off this credit card. It's $10,000 and that's going to help me buy it. Ask first. It can, but most of the time, sometimes it can be bad too. So don't do that.
Yep. Yeah. So those are pretty simple.
Yeah. Stay the same. Yep. Alrighty. So these are the common pre-approval mistakes while you're going through the pre-approval process. And I think we were talking about this before we even went live.
Yes. So make sure when you get a pre-approval that you have a cost estimate.
Yes.
So usually when you get a pre-qualification, they're not going to give you a cost estimate.
Nope.
So and this is for any loan product, whether it's VA, USDA, because VA and USDA are 100% financing, but that doesn't mean you don't have a cost.
Yes, you do.
So yes, always get a cost estimate so you can see what all those fees are, because it does still cost money to purchase a house. Whether you're purchasing a $50,000 house or a $150,000 house, there's still a cost to it. So some other approval mistakes making big purchases.
Yeah. Don't do that. That's the don'ts. But one other one was, wait, you go ahead.
Oh, I was going to say, and what you just said, like paying off credit cards. Like, sometimes you don't necessarily need to do that because
not all the way. Sometimes paying all the way actually hurts your credit score if you're trying to improve it, and sometimes paying it down to a certain percentage is actually the best way.
30%.
Yeah. So just make sure you talk to Kelly before you make any decisions before and during and after your pre-approval process, because it can be detrimental to your ability to purchase. I think another big mistake that we can bring it up is people not understanding what their costs are, not asking, hey, lender, how much does this actually cost me to buy this property.
And
They
what are
don't
these
know.
fees?
And what are the fees? Yeah, understand what they're charging you, because a lot, you'll be surprised on how many people come to me with a pre-approval in hand, and I'm like, oh great, you're pre-approved, congratulations. How much is your closing cost? Huh? They don't even know. They don't know what their total expected out of pocket is. They don't even understand what their monthly payments are. So please, that's like the primary mistake I see when you are just getting pre-approved. Understand your numbers. How much am I paying on this loan? What is my actual out of pocket money that I need for this type of approval that I got? What is the monthly payment expectation? What is my range of the interest rate's not going to be certain because they can lock you in, right, Kelly, until you are under contract.
Correct.
But they can give you an expectation, like an estimate range of what your interest rate will be based on your profile. So at least you have an understanding, okay, this is what I can expect my monthly payments to be, this is what I can expect my total out of pocket to be.
A lot of people think that they're locked into the interest rate too when they get a pre-approval. Yeah. And that is not the case.
You don't get locked in until you're under contract.
Correct. And interest rates, and even then, depending on how long it is to settle, you know, when I lock people in, it's either for 15, 30, or 45 days, but I'll say, you know, you're locked into this interest rate, but you're only locked in for this amount of time. And if something happens that we have to extend it, there is a cost to extend your interest rate.
Yeah. So, yeah, people don't know this, but there's a cost associated to locking an interest rate for a certain amount of time. So that's why the lenders would never lock you on a pre-approval, because it could take you 6 months to find a home. It could take you 6 weeks. We don't know. Yeah. So it makes no sense to even lock you on an interest rate before you are under contract. And even after you're under contract, they may still wait a week or two, depending on how lengthy is your settlement time, your escrow time, in order to lock it in. But yes, that's another one that I see a lot of people just don't understand it and don't know.
Yeah.
And I think another one that we mentioned before, I always say, don't go with the first option, especially if you're not comfortable with that first lender you're talking to. If it's someone you're comfortable with, like, let's say I refer you to Kelly. I know Kelly. I know she's going to take care of you. You might not need to shop around. But if you are just on your own searching, I would say it's wise to shop between lenders and compare what you're paying and what they're giving to you, asking for those cost estimates.
Lender discount fees.
Yes. But
that's the biggest one to look for.
What is that?
The lender discount fee.
How much
that charges, because a lot of times they're like, well, I'm getting this interest rate and your interest rate is up here, but I'm getting this interest rate down here. I'm like, yes, but what's your fee that you're paying for that interest rate? So
that's a good one to bring it up. A lot of people, I'll go with this lender because this lender is giving me 5.5 interest rate and this one is giving me 6. So I'm going to go with the 5.5, not looking that lender that is giving you 5.5 is charging you 1.5 points, which on a $300,000 home, we're looking at almost $4,000. Yeah. And then this one is charging you nothing to get you the 6. So because it costs you 0. So go back here, because that makes more sense. So people don't know that. That's a good one to bring it up.
Yeah. That's a common,
very common.
Very common.
Yeah.
And I had this customer come back to me even after I'm being under contract. Well, this guy's telling me his interest rate is this. I'm like, I can give you that interest rate too, and it's going to cost you this, which was still less than what he was charging you. So if you want to pay that interest rate, I can give it to you. You pay what I show you. And I mean, literally, she went back and forth. She did end up going with me because my interest rate was always better. I don't even remember who the other lender was, but like, it's okay to shop around. It's
but again, going back to understanding your numbers is so important.
Yep.
On that note too, if you do decide that you want to shop around for lenders, don't go crazy and talk to 5, 6, 7 lenders. Try to limit yourself to 3. I think that's maybe 2 to 3. That's the sweet spot. Because if you do it within 14 days, and I think we mentioned this in different episodes, it doesn't hurt your credit multiple times. You're gonna get hit once, but that's still an inquiry that is gonna pop up on your history and increase out.
We're gonna ask about it.
Yeah. So you don't want to see 5, 6, 7 inquiries in there. 3 is reasonable. 4 if you have to, but I wouldn't go beyond that Plus, if you haven't found a good rate at that point, I don't know.
Or
Might
even
be
a good lender.
a good lender at that point. Yeah.
Maybe you need to wait.
Like, talk to me and I'll recommend you to Kelly. So we're done in one. Like, you need to find someone good at that point.
Right.
Yeah. So don't go too crazy. No, that's definitely a mistake that some people do or not do. Like some people don't shop at all. Right. They just go with the first one and maybe an online company and it's not the greatest and they don't even know what they're paying. They're paying too much. Or they shop too much and they go crazy on the increase. And that can actually jeopardize a little bit of your ability there too, because it doesn't look good on credit. So yeah, so I think that's basically all the ones that we could come up with, right? All right, so to end this with, we're going to talk about handling rejections and what the next steps could be. So you go and you talk to a lender or to Kelly, and unfortunately, you're not able to qualify at this time. But then what happens? What would you tell them, Kelly?
I would tell them why. Obviously, a lot of people don't like to hear, why they weren't approved for what they thought they could be approved for. And I would explain to them, whether it was their debt to income ratio or their credit. If there's their debt to income ratio, then it's time to look at your budget, see where you can save, see if there's any other extra income. Do you have Social Security income, any 1099, like anything, any other extra income, child support, alimony, anything like that. So, if income is an issue, that's, is what it is, unless you get a new job or, you know what I mean? Like you need to know what you can pre-approve for. If it's credit, then that's...
When it comes to income, you can always maybe find a co-signer, right?
You can have a non-occupying co-borrower. Absolutely. That is definitely a thing.
There's different routes that we can try to recommend. If it works, it works. If it doesn't, then it is what it is. But
and if it's the two main common things are debt to income ratio and credit. They're usually the two main things as to why you're not pre-approved.
Yeah.
So it's always finding out the why. Like why can't I? And with the credit, that's where if you're going through me, I don't recommend going through creditors that you pay monthly to help with credit, just because you never know if they're legit or not.
Yeah.
And if you are paying for it, make sure you
actually get your service done for you.
That you know what they're doing. Follow up with them. Credit Karma is definitely a good one. That has helped people. Usually, Credit Karma's credit scores are still going to be different than what mine are, but Credit Karma is a good one that helps.
Yeah.
But yeah, you always want to know what they're doing, how they're helping you. Get documentation. Yeah. If they're telling you that they're doing stuff, get it in writing. That is one of the biggest things. So then you have this. If they're telling you that this is being paid off, and then you go to a lender, a month later, and they're like, "Oh, well, this wasn't paid off," or you're like, "But I have this document telling me that it was paid off."
Then, so where did that money go? That's scary. Yeah.
So that's so literally your next steps are just to find out the why, and then you figure out. Once you know the why, then you should know the steps to move forward with getting ready to purchase a house.
Yeah. So. And don't be discouraged, because we always tell people here, like, when is the right time to buy? The right time to buy is when you're ready to buy, and then when you want to buy, right? So that's the right time. And if you're not approved now, because it wasn't your time yet, and we're going to help you get there, between your agent and your lender, being me and Kelly or someone else, you should be able to coordinate the steps in order to get there. Anybody that really wants to and plans ahead can achieve homeownership. I hear some people saying that homeownership is not for everyone. That is not true. Everybody can get there if you plan ahead. There has to be planning, though. That's why we say, you don't come to us when you're like, I want to buy now. Well, yes, do come to us too, but if you're not ready now, we're going to help you get there. But don't be discouraged when you came to us and we told you might need 6 more months, or you might need another year, or you might need to just get more payments, or you need to pay down this debit, this debt. So there's different things that can come along, but don't be discouraged, because your time can come. It's just working towards that. And I've had so many people, now that I've been a few years in the industry, that I maybe talked to 5 years ago, and now they're finally buying. So it takes how long it takes, but homeownership is definitely possible if you put the work to it and if you're planning in advance. So do not be discouraged. Don't think that you're not meant for it, because that's not a thing. Definitely. So that's it for us. Do you have anything else, Kelly, to add before we go?
I don't think so. I think we had covered everything with the pre-approval.
No, that was great. You're very insightful on this one, so thank you so much for giving so much detail. If anybody had ever questions about what a pre-approval is, I think they need to watch this episode.
Yes, we'll be sharing this one everywhere.
For sure, yes. Alrighty, guys, so that's it for today. We are excited to see you guys next week. So next week, what are we having again, Callie?
Home inspection. Yay! Kevin Smoker. We have a guest speaker, Kevin Smoker. He does home inspection. So
I love it. The special episodes are the best. So we're very excited to have our guest speaker here talking about home inspections, which is so important. Even though we're not seeing them too many times right now in this market, but it's still an option, and we definitely still encourage. So
he will tell you the importance of them.
Yeah, you tell you just how important they are. So I'm excited for that. We'll see you then next week, and have a great day, guys. Happy house hunting. Yay!